The prodigal son returns. I guess that would be me. We're going to talk a little bit about some of tomorrow's economic announcements that are upcoming and take some of your questions today on Open Interest. Hello, everybody, and welcome. I am Mike Coe. Welcome to Open Mic, and I'm actually going to take the first comment I'm going to take is related to where I was last week. Our family was going to go camping. We did go away, but we did not end up camping. I actually saw a very funny post on X about it. You know, how everybody raves about camping, and then they tell you about the 2 a.m. fight that they had with a raccoon. We didn't fight with any raccoons. There are a lot of bears where we went, and we have a big dog. And at the last minute, my wife called an audible, and we rented a house in Lake Tahoe instead. But it was nice. It was a nice time. And it was a nice enough time. You know, we have 2 teenage sons, 16 and 17 and a half. And they both voluntarily said, yeah, let's stick around for an extra day. And as far as a parent is concerned, anybody who has teenagers, you probably know that they're much more interested in hanging out with their friends than with their parents. So we figured we must have been doing something right, that they decided that they would spend an extra day up there with their parents and the dog, then come back home and hang out with their friends. So all good. And the summer is rapidly coming to a close. So there was very little time to get that done. We still did some, quasi camping types of stuff. So we cooked out, and we went on hikes and went to the beach and things like that. So it was all quite enjoyable and a nice way to start wrapping up the summer vacation. Okay. So one other quick thing, and this is actually going to be a little bit about getting some input from all of you, because one of the things that I had done was in the past discussed a little bit how upcoming economic announcements might impact various asset classes depending on the results. Now, we haven't completely formalized how we intend to present this information, but we're working through some ideas, and I figured I would just show on my screen here one of the things that we're thinking about. Let's see if this works. And I'm going to probably have to, oops, that did not share to the right screen. So I'm just going to drag this over. We'll have a look. I think it might be a little bit busy. So in fact, this is a real economic announcement. It's coming out tomorrow. So we're going to be getting CPI data. This is just a headline thing. There's going to be the month-on-month, year-on-year data. On the month-on-month basis, just in terms of what the survey number is, it's expected at 0.2%. Prior period was 0.3%. Obviously, if it comes in any hotter than the prior period, that in particular would be viewed fairly negatively. But really, I guess my question for all of you, and put it in the comments section, or you can put it into the live chat as well if you have any interest. We are just trying to identify the best way to pick the 2 critical levels, where is a much better than expected and a much worse than expected, and the likely impact. So, for example, if the number comes in greater than the prior period of 0.3%, that's probably going to be bad for equities, and most specifically for high duration equities. So that's going to hurt things like XLK. It's going to flatten out the curve. Short-term rates are going to rise. The dollar would actually probably be flat to higher, simply because you're going to see an expectation for higher short-term rates, which is generally better for the dollar. It's generally going to be worse for gold. So the dollar and rates are positively correlated, and gold and rates are generally negatively correlated. And if it's indicative of inflation, then maybe that could create some measure of support for oil prices. And then contrarily, if the number is less than 0.1%, then in many cases the opposite would happen, except for oil. So this is one of those things that very often you can get economic releases. And the reason it's important to take a look at all of these things is because you begin to understand what sets up as what we call a barbell trade, where you essentially have two bets on that are not necessarily the opposite of one another. So you can have a situation where something is good for two asset classes and it might only be bad for one of them, and consequently you can help structure your portfolio that way. And so my idea is that we come up with ways to display and report this information regularly. It could either be daily or maybe once a week. We haven't quite sorted that out, but we're looking for some input, and so we're really very happy to get your input and thoughts on that if you have any. Okay, FinWest just followed up and said, camping turned into glamping. I like that style much better than sleeping on the ground. It's funny that you should mention that, because one of the things that I was definitely looking into as a part of the camping situation, there's a private club near here, sort of a hunting and fishing club, and they have that the safari tent arrangement. So you're actually sleeping on a small bed, basically, not in a sleeping bag on a pad on the ground. That doesn't appeal to me a whole lot either, to be honest. But there are ways to camp that make it into quite an adventure. But I think a last minute camping trip is something that just has a lot of potential points of failure, particularly for those who don't do it a whole lot. Did it when I was a kid, but I think I'm probably a lot softer now than I was when I was in my teens. So and I don't know that my kids who are used to things like iPhones would have viewed it quite as the same way that we did when we were kids. Anyway, okay. So Ranjana Gupta asks a question. Apparently, you watched Fast Money. I got back on Friday and I did do the full hour of Fast Money, and you commented that all the guests, including you, that would be me, were bullish on gold. Please draw up a trade on OptionsPlay for GDX. So for those of you who did not see Fast Money last week, that's true. All of us who were on, it was Carter Worth, Tim Seymour, myself, and Bono and Ison. Our general thesis is that you stick with trades that are working until you have definitive evidence that they no longer are. And, the principal drivers for gold is that, we have big institutional buyers, central banks are net buyers. People who are concerned about fiat currencies are net buyers. Obviously, crypto is taking some of the investment for people who are looking to hedge against fiat currencies. But gold is the oldest sort of stable money we've got, and I think we have reason to continue to support it. Now, the reason I mentioned that conversation, and I don't know whether that you can probably find it online. I think if you go to CNBC, they stream segments, and if you probably put Fast Money Gold and the date, you'll probably catch that segment. One quick thing I'm going to say before we put the trade on GDX on is that Carter's point was that the miners are generally thought of as a way to get additional leverage to the space, and I agree with that in the sense that when the commodity starts to really catch fire, particularly if the underpinning costs, the expense side that the miners face, are not appreciating as rapidly, or even better, are coming down. Like, so for example, oil prices have been coming down, and there's a lot of energy involved with mining for gold. So that's a benefit. If your expenses are dropping, just as the prices for the goods you sell, in this case, the commodity gold, are rising, that can be spectacular for margins, right? And so the general view has been that the miners and the junior gold miners are a levered way to play a bullish bet in the underlying metal. For a while, GDX had underperformed. Let me see if I can actually pull that up. I'm going to do that. So for a little while, we had a situation where the miners were not really exhibiting. I'm going to use oops, that's a typo. I'm going to put the gold ETF in instead of the actual commodity, because I don't think this feature is otherwise supported here. So one of the things that you can see is that if from about here, so gold was about where it was, we'll say call it flat relative to September 2020 in here, the GLD ETF, but has obviously rallied significantly. But it does appear that GDX has outperformed in that time frame. So let's just take a quick peek. That is February 28th of 2024. And here you get to see exactly what we're talking about. You get that leverage out of the miners. I have not done a really extensive study on this. The common way that I've heard some people refer to it, Steve Grasso, who's on CNBC all the time, regular contributor for Fast Money and probably for other programs as well, has often said that he sort of thinks of the miners as being sort of a 2x levered way to play gold. That, as it happens, as you can see right here, since February 28th, which is when I identified on the chart that we really started to see that outperformance, that's been almost exactly the math. Is that slated to continue? Well, according to Carter Worth, at least on Friday, his attitude was, and that's why I encourage you to look up this segment if you can find it. So again, that was today's the 11th. So we're talking about August 8th, Fast Money, Carter Worth Gold, Google that. And I won't try to say what he says so eloquently, but the gist of it was that his attitude at this point, given the outperformance that the miners had seen, that he would just assume the metal. But like I said, this is the trade that's working at the moment. And it's not like that outperformance has really rolled over of late. If anything, you can see that actually it sort of extended those gains. That was his reasoning for going with GLD rather than GDX. But the operating benefits of static to lower expenses for them in a high gold price environment, that still remains true. So I'm just throwing that out there so you sort of have all aspects of that conversation for those of you who didn't watch. But since Ranjana is asking specifically about GDX, let's take a look at a trade for that. So actually, before let's do this. So why don't we just expand this to a longer term chart and think about sort of critical levels where we might be concerned about some potential downside. This most recent rally that we've seen in GDX really occurred over the course of just the last few days. Had been in this range between, for the GDX, about 54.5 on the upside and about 50.5 on the downside. So that's kind of, if I'm concerned about anything, it might be that it could potentially fall back to that because we're only a couple days into this relative outperformance. I think call spread risk reversal makes some sense. One of the things about GDX, of course, is that all will know who've watched or listened to me a lot, you probably know I'm not crazy about selling tons of premium around catalysts such as earnings. When you're dealing with an industry-specific ETF such as GDX, that means that what applies to one company may very well apply to some of the others. Now, there are idiosyncrasies, of course, right? So some miners have greater exposure to areas of greater geopolitical risk than others do. So it's not all exactly the same thing. Also, some of the miners, and this is an important point, somebody else had made it, and maybe this is one of the things that, Ranjana, you're thinking about, is that the miners, it's not like gold is the only thing that they produce, right? It might be the only thing that we're really thinking about, but it isn't necessarily the only thing that they produce. Okay, so now that we have sort of that other level, there is some diversification, so we're not going to be too concerned about any specific corporate earnings, but let's just bear in mind that corporate earnings, for one, could have a more outsized effect on other constituents of the gold miners select sector index, which this tracks. Those correlations could be a little bit higher, so there will be a little bit of a carry-on impact. But if you're going to use something like a call spread risk reversal, when we're using something like a call spread risk reversal, you're going to be short more options than you're long. So I think some of the general guidelines and the timing for the short structure, bearing in mind the technical levels that we've identified, should look a little bit like, basically the strategies that have historically performed well. So that's going to be, something in the neighborhood of the 20 delta strangles or lower. And that's what we're going to use in this particular case. Maybe an 18, something like that. So we're going to pick an at the money call. I'm probably going to just choose the first out of the money strike. And I'm actually going to shorten this up a little bit, take it into, we'll call it a 7-8 week time frame, and see what we can do. Do we have a limited number of strikes here? We are a little limited. Let me just double check this. That seems fishy. Usually in actively traded issues on the weeklies, we get dollar strikes. I'm not seeing that. Looks like a $2.50 increment. Is that correct? Let's find out. By the way, I hope all of you are enjoying the last few days or weeks of summer. Getting ready for back to school and all that kind of stuff. Let's see here. You can feel free to share your, isn't that interesting? Huh. So we've got 50-cent strike increments up until $63, and then all of a sudden it just bangs out to 65. Okay. All right. I thought there might be a data issue there, but apparently not. Okay. So we'll do the 19 delta calls on the upside, and this is actually something else I was pointing out to somebody else who was doing a lot of short strangles work, and that is that, don't be afraid to adjust the strikes in favor of the direction that you have for the underlying. In a call spread risk reversal, this is a little bit less important. So what I mean by that is, let's just say that you have a mildly, a neutral to mildly bullish thesis for the underlying asset, knowing a couple of things. Stocks generally rise over time, and the more time you give them, the more likely they are to. And if the rest of your thesis also supports a somewhat bullish case, if you are just looking to collect premium by doing something like selling short strangles, that's still okay. Just fade it so that you have net long delta. So maybe you sell a 25 or a 30 delta short put, and you're only selling a 15 delta short call, something like that. Now, in this case, because we're buying a call as well, and a 50 delta call at that, this is less of an issue. But I just sort of wanted to make that point. It was part of a conversation I was having last Friday with somebody who does a lot of short strangle work, and they'd asked me to analyze their performance, and they were saying, has any pattern emerged? And the pattern that emerged was that their assignment, and it was over a pretty substantial number of trades, their assignments were happening a lot more often on the call side. Now, of course, that's going to happen. The market's sort of been on a tear here. But yeah, it's definitely something that folks should sort of keep in mind. So with that in mind, 55, remember that was sort of that level. We'll pick 54.5. So that was sort of that upper end of that range, right? So you could choose something like 54.5 or a little bit lower. But basically the idea is, if this sort of breakout that we're seeing now proves to be unfounded, choose a level at which you're happy to be put the underlying. And we come up with something a bit like this. All right. So there we have a GDX trade for you. And I think, Finwest said that he Googled the fast money gold CNBC and that segment appeared. So he can't post it in here, but I encourage anybody who's interested in seeing what that was all about, by all means, do that. And then you're not going to have me paraphrasing what Carter said and what Bonawyn said. Instead, and Tim, you'll hear it from their own mouths, which I strongly encourage. Okay, so this is effectively what we get, and yeah, I think that's a fine trade for this. Now, there is something else I said, which I think I should probably point out. I did say that I think we're going to finish the year higher than we are right now, with the following caveat. And that following caveat is this: we have a very high probability of a rate cut baked into the cake for the September FOMC. So if we start getting economic data that is problematic in terms of the Fed cutting rates in September, that presents a real risk because everybody's expecting it, right? So the risk is that you don't get it now. If you get to a point where there's a 95%, I think as of Friday's close, the probability of a rate cut that was baked into rates prices on the curve was something in the neighborhood of 90%, right? So if 90% of the investing public says, oh, we're definitely going to be getting a rate cut, well, that means that the risk is that we start getting information that suggests that we won't. Now, when I was looking at the earnings results for the S&P through the end of last week, so from July 1st to the end of last week, about 430 companies in the S&P 500 had reported over that period of time. Of those companies that reported, nearly 80% had revenues that beat street estimates. And which I think is important. It's important in a general sense to say, okay, well, they're doing better than the street expects. That's something we care about. One of the things that I also care about is, okay, forget about what the street expects, just how are we doing, full stop. In round numbers, the revenue growth for the S&P 500 of those companies that had reported by the end of last week from July 1st, the year-on-year revenue growth for the reported quarter was better than 6% revenue growth, which is it's pretty good. It's a number we throw around a lot, but the whole idea is, the S&P revenue growth and EPS growth is going to be substantially better than GDP growth. It looks like it's tracking at least 2x GDP growth on the revenue side. Adjusted EPS grew. It wasn't quite as many that beat expectations on that. It was just under 70%, I think, if memory serves me. But the adjusted EPS growth was about 12%. And that is substantially better than even the relatively recent compound annual growth rate for adjusted earnings in the S&P overall, which has been about 8.5% over the last, basically since the pandemic period. Maybe not that surprising. If we go back to 1990, it's about 7. So 12% is a good number. Now, so that's the good news. What's the bad? Well, the bad news is I was trying to think, why would this be true? What are some things that could cause better than expected revenue growth when we know that consumers are weak and we know that consumers represent 70% of the U.S. economy, and particularly see such substantial margin expansion? And one theory I have, and it's not even a theory, what's lower than a theory? Hypothesis, conjecture. So, a theory has a lot of data to back it up. But I was speculating on potential causes for this kind of result. And one of them that I came up with is we have a 70% consumer-based economy, and there were a lot of expectations for tariffs. It stands to reason that companies may have done a couple of things. They may have accelerated purchases ahead of anticipated tariffs, or they could have potentially increased prices ahead of anticipated tariffs. And what happened? Well, the tariffs, the initial ones that were announced, at least on that Liberation Day, got delayed. So you could have seen, so we could now be seeing some operating benefits that were a result of pricing action and consumer behavior in anticipation of tariffs that didn't come right away. So as we go into, as we get closer to the next earnings season, right? So I'm looking at the July 1st to present period. The one that's going to matter to us is the October 1st period and beyond. What happens in September? Okay, we have the FOMC, and we're going to get some economic data in between now and then, which might dilute people's expectations for a rate cut. So that's one problem. The second problem, potential problem, is that September represents pre-announcement season. So to the extent that there is a possibility that tariff impacts that were anticipated but only delayed end up impacting corporate results in a meaningful way, September is the month that you're going to see it. Because if they have a material impact, they're probably going to pre-announce, and they're not going to do that, the week before they announce. They're going to do it probably as soon as they fully recognize it. So the caveat that I gave, that my expectation is that we could finish the year higher than we are right now, is with that one piece, that speculation, conjecture, whatever you want to call it, that the tariff impact was delayed, not completely missed. So that's a little bit of bad news. And one of the reasons why I wrote an article, did I put it? Did I put it on the CNBC website? I'm not sure. Well, it's not up to me to put it on this. Did CNBC put it on the website? I'm trying to remember whether I provided it to them. Doesn't matter. I'm going to tell you guys what the trade was anyway. My thinking was that in those instances, so between now and September expiration, call it 50 days away or so. So let's just go over here. 50 days away? It's exactly 50 days. Okay. So 50 days away to September 30th expiration. Over a period of about that time, so we're looking at 7 weeks, going back a century, the S&P is higher about 62% of the time. Okay. When it is not, that is to say, in those 38% of cases where the S&P actually declined over a 7-week period, the average down move was about 5%. So now the price today in SPY is actually a little bit lower than it was when I wrote my piece about this. But let's just call it 635 to keep the math easy. So that gets us down to 603. So if you're saying, okay, well, maybe the probability of a down move is a little bit bigger than that random case, over all periods, which is 38%. And I'm going to target kind of that downside move of, we'll just put this to bearish, of about 603. Why don't we just take 635? We'll make the math nice and easy. You'll say 635, 600. And I have to go back because September 30th, this is when I really think you want to have that protection on. Owning insurance all the time is not a good exercise because, as I pointed out, the market usually rises. Over a period this big, 62% of the time, going back a century, it's been higher, right? So if all you had to do is throw a dart at the board and pick higher or lower, it's gonna hit higher more often than not. But you can see that the cost of this trade is 688. It's about 1% of the underlying. And most people's positions are going to probably track something a bit like that. Notice the probability of profit, by the way, 37.64%. Kind of interesting, right? Because what did I say? 38% of the time, the market was lower. And so, the options market sort of pricing that out. What I'm saying is that I think the tariff impact on inflation statistics could be the fly in the ointment, if you will, that makes it a little bit more justifiable. And also September is generally a slightly above average month in terms of volatility. This trade, I think, sets up fairly reasonably. Okay, so having gotten that out of the way, there's one other thing that I thought about, which I think is also worth discussing. I keep hearing this. I'm sure you've heard it too. Tariffs are inflationary, right? True enough. If I have something that costs $100 and you impose a tariff of 15% on it, someone's got to eat it, right? So the company could eat a portion of it, the consumer could eat a portion of it. Very likely they're both going to end up eating a portion of it. There's a company called Sigma. It's a Japanese optics company. They imposed a 10% price increase in anticipation of tariffs. Now it's going to come out to be 15%. They've decided to absorb the other 5%, something they can afford to do because they're a very vertically integrated company. But there's two different types of inflationary impacts that can take place. So the inflationary impact of perpetual money printing is a very different impact than imposing a tariff. Why is that? Well, the reason is that once you've imposed the tariff, that does not necessarily become a perpetual tailwind to inflation the way that money printing does. If you're constantly increasing the money supply relative to goods and services, the inflationary effects are going to persist. That is to say, maybe your inflation rate wanted to be 2%, but you ended up with 3 or 4 or 5%. But if you impose a tariff, that's a one-time thing. That $100 good, which is now going to be $115, let's just say that the consumer eats it all. Well, they don't impose a new 15% tariff on that the next year, so that the 115 now becomes 130 and change. It's a one-time step function in prices that takes place. And I think this is an important consideration. By the way, I just saw that thing in the background. I don't know if you guys can see that, where it says Yield Max, where it would normally say Open Mic. I have Yield Max up there because some of you who may have seen, I did a live stream about Misty a while back, which is the Yield Max covered call strategy for MicroStrategy. Now just Strategy, because Michael Saylor, I guess, wanted to change the name. And I have agreed to do some strategy work for the Yield Max brand and their suite of ETFs. So you'll probably hear me talk about those, maybe not on Open Mic so much, but you'll probably hear a little bit more about me, and that's part of the reason that I have it up on that monitor in the background. So just to finally button this whole thing up on the tariffs and the inflation and my concerns about pre-announcements and in a normally somewhat higher volatility September, that seasonal effect that sometimes follows Labor Day, I think it's not a bad time for hedging. So we will leave it at that, and hopefully you find that helpful. Okay, so hey, Mike, are there any robotics companies you like? Tesla, not really a pure play. So yeah, I mean that is a good point. It's not a pure play in the sense that, you know, Tesla is a very valuable company. There's a lot priced in for the auto business. And so I do agree with you. That said, if I had to bet on anybody to come up with a game-changing robotics product, you know, Tesla would be on the short list. So that's kind of the challenge that we have when we consider, okay, what companies are most likely to bring a product to market. And, you know, normally the way I have historically thought about things, you know, I've often felt like when it comes to innovative technologies, they often come from quarters that we didn't expect. That could be true here too. The exception, though, with Tesla is that Elon Musk has managed to bring forth so many things that it just seemed so improbable, frankly, that they would be successful. And I think it has something to do with a combination of his vision, his ability to get the most out of the people that he works with, and probably their enthusiasm for it, propelled in no small part by his prior successes. So when I think about companies that could bring something to market that really gets broad adoption, on the short list of participants, that's definitely one of the companies that I can envision. Beyond that, I guess I would have to say chip companies. I think they're going to have a big role to play. And, there's going to be a lot of, learning and things like this that go into it. So that sort of gets us to the big sort of legacy players. It would be nice to think that maybe older players that have sort of been left on the sidelines a little bit, partially because they were being run by marketing people instead of engineers, like Intel might actually somehow get in on it, but that remains to be seen. So maybe buy SMH if you're a little uncomfortable reaching out and buying Tesla at its valuation, which obviously has a lot of other baggage coming along with it. If it is baggage, I actually think that memories are short. I think that Tesla managed to alienate some core consumers. I've referenced that earlier. I live in Northern California. Probably the highest rate of Tesla adoption of any auto market in the country, maybe the world, is within 50 miles of where I currently sit. And the bumper stickers and things that we see, the little stickers that are slapped up on telephone poles, that kind of stuff suggests that there was some alienation of a core customer base. But I do think that people's memories are short. And, I don't know that there's been permanent damage done. Oh, this is an important point too, by the way, and probably some of you saw this, and that was that the board approved a fairly substantial compensation package for Elon on the basis that he should, refocus his time and energy. I don't know that he necessarily needed to have an additional incentive to refocus his time and energy. I mean, my guess is for somebody like him who is very used to having a vision, going someplace and making real change in relatively short period of time, going to DC, nothing could dim your enthusiasm faster than that city, I suspect, in terms of getting things done. And maybe because of that, he will indeed focus most of his time and attention on commercial enterprises. And as he does so, my expectation is that the companies and the products will benefit materially from that. So, yeah, that's neither here nor there, but that's my 2 cents on that. So looking for headline-grabbing robo companies, humanoid, etc., or practical plant automation, agriculture. I feel like Tesla is the former. Yeah, well, that's actually a very good point too, right? Because we have obviously a lot of robotics activities that go on in manufacturing. Anybody looks at a modern automobile assembly line, and you can see that. Actually, you look at almost any modern assembly line, and you can see that robotics play into it very heavily. I think, though, I suspect that Pepcapstick is actually talking about that kind of thing. You can validate that for us, but I'm assuming that what you're actually talking about is, sort of the new and sexy robotics rather than legacy manufacturing robots companies, that type of thing. But yeah, I will do a little bit more work on that before I just start throwing names out without actually taking a deeper dive into them, and hopefully I can have some stuff for you guys on Wednesday as far as that goes. Okay, so while I have you, because I do have to, today's only going to be a little shorter than usual. I wanted to just touch on some of the other economic announcements before we go that are going to be upcoming. Not that one. And let me see here. At least we'll try to just cover those items that are going to take place before I see you guys again on Wednesday. So as always, we've got the MBA mortgage applications. I'm not really going to focus. It's something that you should always pay attention to, but we haven't had big shifts in rates, and people are expecting big shifts in rates. I'm a little bit annoyed when I constantly hear people say, oh, when the Fed lowers rates and they lower mortgage rates. Well, mortgage rates are driven off the longer end of the curve, and sometimes lowering the rates in the short end can actually steepen things. So that doesn't necessarily affect the 30-year fixed. Nevertheless, people are looking to see signs of rejuvenation in the housing market, and that's going to be important because we still have some companies in that space, like Home Depot, that are set to report. Home Depot reports next week, I believe. Let's see. And the valuation, I did write an article about that one. Yeah, so they're reporting on the 19th. They're trading at around 26 times forward, which, just so that everybody's aware, is pretty much spot on the historical average for the company. But their growth rates, I was just talking about growth rates for the S&P generally, their growth rates over the course of the last couple of years and looking forward are not like the S&P. And you'll remember that, and I like Home Depot. I think the company is exceptionally well managed. There's a lot of things I like about what they're doing. The issue that I have, Lowe's is trading about 18 times, by the way. So they've been better. They have better sales per square foot, 50% sales from prosumer. They have this omni-channel approach, which I think is really good. They have something like 1 million SKUs available on their website. But the issue that I have is that you really need to see the growth reemerge. We really need to see the longer rates and mortgage rates come in. And the issue that we have with Home Depot is if it's growing the top line at 3 or 4%, and it's growing the bottom line at, call it 6 or 7%, are respectable numbers, and it's trading 26 times. Why do I want to buy that instead of the S&P growing at 6.5% on the top line and 12% on the bottom line at 24 to 25 times? The only reason I would do that is because I thought that growth rate was going to accelerate materially. And the only way that's going to happen is for those longer rates and the mortgage rates to come down. And remember what I was talking about, tariff impacts. Home Depot is one of these companies where, we have to wait and see what the tariff impacts are. And I think it's okay to wait. So it's nice to have, it's nice to have an answer every time and say, it's a company I like the management, I like what they're doing, and the valuation is, I guess, reasonable. But I can't say I'm behind the stock ahead of earnings on the basis of those issues that I've just identified. Lowe's, for what it's worth, just so we can give it some perspective, it is more, they have a smaller percentage of pro sales. Consequently, they trade at a lower multiple. And the consumer sales tends to be a bit more volatile. But all of that said, 18.6 times, I kind of feel like it might be a slightly safer bet, but the problem that we have here is they're also a little bit flat on the top line and the bottom line. So my view about both of these, which are going to be reporting, is just sit tight. If we they don't actually, one other quick point, they don't tend to move a whole lot on earnings. I think the average move for Home Depot is about 3%, implying about a 3% move. Lowe's, the average move is, and for those of you who have unusual whales, I should probably be pulling it up on that. That's a better way to illustrate it, right? Oh, I'm in. Okay. So go over here to go to earnings. So look at Home Depot first. So here's a 12-quarter history. Yeah, it's what are we looking at? Implied of this was the last quarter actually. So look at this, they expanded it to 18 quarters. So I'm glad we came over. That's yum. Gotta switch that. But yeah, so what are we implying? What did I say? 3%? Actually closer to 4%. 4% implied, but you can see that's, it has historically been well inside of that. This is, I'm glad they did this, by the way. This 18-quarter feature was not something, you guys have seen me share this screen before, but yeah, the number it was previously 12. So that's Home Depot, and let's just take a look at Lowe's as well. And that one's implying 4.4. And again, you can see that we're looking at these green dots. Green dots simply indicate that those are the cases where the stock's one-day earnings-related move was within that the options market had implied ahead of time, ex ante. So yeah, we have that. Okay. Here we are. SanDisk reports on Thursday. Take a look on Wednesday for an options play. Yeah, we can do that. Let's just quickly here too. We can just definitely. I'm going to have to ask somebody on the production side. Just remind me that we can take a look at this one. Oh, wait a minute. Yeah, okay. So I'm just going to confirm. I want to make sure that they actually report after the close, because it wouldn't do us much good to postpone until Wednesday's open mic to discuss it if you don't get any chance to trade it before they report. These companies traditionally do, if you're looking at the companies that are West Coast based, they do traditionally report after the close, but let's go to their investor relations and confirm that. And always, whenever you can, go straight to the source when it's something like this. And there you have it. On the 14th, 4:30 p.m., right from the horse's mouth. SanDisk Investor Relations. Let's just go ahead and add that to our calendar. And we're going to add it to our things to talk about on Wednesday. It's a very good topic, I think. Now, normally I would carry this for the full hour out to about 5:15 Eastern, 2:15 local. But I do have a call scheduled at 5:15 on the button. So I am going to have to, unfortunately, jump off just a little bit early today. I appreciate all of your patience for that. And let's see here. What PepCap stick? So robotics from all forms as a cost is rapidly decreasing. Yeah, Schwab has a theme of 25 stocks from industrials as 3 examples. Intuitive Surgical. Why do I think we had talked about Intuitive Surgical? It's been a little while. But yeah, I mean, I think of them more in terms of medical devices than robotics, but obviously I think it's good to keep our eyes on that as well. So yeah, why don't we try to, we'll do that. Let's decide that SanDisk pre-earnings and robotics will be among the themes that we try to touch on Wednesday, when I hope to have a little bit more time than I did today. I'm not scheduled for fast money on Wednesday, so we should be good to talk as long as we like. For all of you who tune in, I want to thank you very much for watching. Like, subscribe, hit the notification bell, and thank you also for giving me the week off last week to hang around in Lake Tahoe with my family. We had a good time, and I hope all of you enjoyed your week as well. I will see you on Wednesday. Thanks for watching.